If you are a home buyer and you're concerned about what your house payments will look like with the new interest rates, today's video is one you really won't want to miss because I am talking to Chris O'Connell at Loan Depot, and we are specifically discussing ways to reduce your monthly mortgage payment in today's financial environment. So he's also going to kind of bring in ideas about what you should be conscious of as you consider these options. And if you stay to the end of the video, he gives us like one more little morsel to chew on about what you might want to do with seller paid closing costs. My name is Mary Schumann. I'm a realtor here in the Twin Cities. I make videos about moving to Minnesota, what it's like to live here, the real estate market, all that kind of stuff. So if that's your cup of tea, please consider subscribing to my channel and hitting the bell so you know when I post a new video. And my contact information is down below. So if you have a question, please reach out because you two people are my favorite people. All right, let's go.
My name is Chris O'Connell. I'm a mortgage loan officer in Minneapolis, Minnesota. I've been a mortgage loan officer for about 10 years, a little more than 10 years now. The company that I work for is Loan Depot. We're a direct lender, which is a little bit different from a broker or a correspondent lender or a bank. We fund and underwrite our own loans and sell directly to Fannie Freddie, so there's no middleman like a broker.
Chris, the reason that I invited you to do a recording with me is because, as you know, the real estate market has shifted dramatically in the last 6 months or so. And I still work with a lot of buyers, and we're walking into a new situation. So all I hear on social media is 2-1 buy down, 2-1 buy down, 2-1 buy down. And I'm like, I don't know. So I want to hear from the horse's mouth, what is a 2-1 buy down and why would that be a good idea? And then maybe we can talk about some other options that might be good for buyers, and also what kinds of things they may want to look out for.
Yeah.
Why it might not be a good idea.
Well, and of course, the 2-1 buy downs, the ARMs, adjustable rate mortgages have become really, really popular as rates have gone up. So the 2-1 buy down is a way to get a low interest rate for the first 2 years that you have your loan. So the first year, your mortgage rate is reduced by 2 percentage points. The next year, it's reduced by 1 percentage point. And the third year, it goes up to the actual rate. So for instance, if your normal rate is 7% right now, that 2-1 buy down makes the rate 5% in the first year, 6% in the second year, and then it goes up to the actual rate. That can make a really big difference in your monthly payment to reduce that mortgage rate by 2% for the first year, and you're saving several $100s per month, for instance, for the first 24 months of your loan, right? Well, you have to pay for that, right? So that the benefit is you get a lower payment. The cost is the actual savings of that reduced rate. So if you're saving, just call it $6,000 over that 2-year period, that is the cost of your 2-1 buy down. So that's the money that you have to pay at closing.
So this is not like some kind of little gift from the bank.
No, this is not a gift. It's something that has become popular now because the market's loosened up a little bit, and because rates are high and sellers are willing to work with buyers, the benefit is really only if you can get the seller to pay for it.
Correct.
And it's a great deal because, again, it does cost money, but if you can get the seller to pay for it, you get a reduced rate for the first couple of years. The idea really being that eventually you're going to be able to refinance out of that. You're going to be able to refinance and lock in a lower rate down the road, assuming that rates go down.
That's the big caveat right there.
That's the caveat right
We're
there.
going to assume that rates are going down, but I mean, none of us has a crystal ball to say that that's going to happen. So if that doesn't happen, if you're a buyer and you get into a situation like this, and yes, you're able to save that kind of money, you really need to plan. Go back then is that we need to have buyers understand that at the end of this, if the rate is higher than 7%, like if we're going on today's terms, that they may not want to refinance and they're going to be paying whatever that 7% interest rate equivalent payment is until
Correct.
rates change.
Right. So you still, as a buyer, you still want to be comfortable at the actual rate. Hey, it's great if you can get the seller to pay for a buy down for the first couple of years, makes your mortgage payment a little lower, but you still want to be comfortable at that actual rate, at the actual higher monthly payment, because you might not refinance. Rates might not go down. You might be stuck with that actual, 7% rate, call it. So if rates keep going up, you might not have a chance to refinance. To that point, adjustable rate mortgages on the surface are attractive because you get a lower rate initially, and those are usually fixed for 5, 7, or 10-year periods, right? So then after that 5, 7, or 10-year period, that mortgage rate will start to adjust to whatever mortgage rates are after that fixed
Okay,
period.
this is really good because I'll be very honest. I don't have a lot of experience with adjustable rate mortgages because I've never had one, and I've only worked in the business during great, like 4% and lower. No one
Yeah.
was getting them. So I really didn't understand that it was that long of a period that you would have that lower rate. So maybe if that's really your concern, maybe an adjustable rate mortgage would be a better way to go than if you can't get the seller to pay that 2-1.
Yeah, so an adjustable rate mortgage, not a bad idea, because you do have that fixed period for years, 5, 7, 10-year periods, which, is a long time. And then after that period, maybe rates go down somewhere in between and you can refinance into a fixed rate mortgage, or, 5, 7, 10 years, you might move out of that house, you might sell, you might do something different regardless with that property. The risk being with the adjustable rate is, maybe rates keep going up and you don't have a chance to refinance if rates keep going up. So that's the risk with adjustable rates is, yeah, your rate is low now, but once it adjusts, if you're not able to refinance out of that, you might be looking at a higher mortgage payment down the road. You can kind of plan that with adjustable rates too, because it doesn't go up to the market rate. It adjusts by a max percentage point when it starts adjusting. So you can have adjustable rates that adjust once a year or twice a year, and there are caps on the amount that it can adjust every year, and a cap on the amount that it can adjust throughout the life of the loan. So even with adjustable rates, you can kind of predict where your payments are going to be, and you can definitely you can estimate what the max payment throughout the life of the loan will be with an adjustable rate, because there's caps on them. So again, adjustable rates, if you can't refinance, they will adjust at higher and higher rates throughout the life of the loan, but there's caps that can only adjust to a max amount.
So when you say throughout the life of the loan, that reduced payment period is only for a certain number of years, and then the life of the loan could be another 25 years of adjustment?
Yeah, I mean, so again, you can have let's call it a 7-year arm, so that, payment is fixed for the first 7 years. Then after that period, it starts adjusting, and it can adjust up to 1% a year, for instance, but it can only adjust up to a max of, let's just say, 5 percentage points. So it can't go to 100%, right?
Okay.
It can only go so high. Your adjustable rate mortgage
But it
can
could
only
go
go
quite
so
high, right?
Yeah, definitely. I mean, a point
Okay.
for
So
sure.
I guess I'm just asking you to educate me a little bit and educate people who may be watching this about, because I think I have in my head some true or false ideas that adjustable rate mortgages are a scary thing and you shouldn't do that. So what, and from your perspective, do you think that they're a scary thing and should we stay away from them, or do you think they're fine?
Well, I don't think you need to be scared of them. I think adjustable rate mortgages might have got a bad rap back during the financial crisis or leading up to the financial crisis, because people were qualifying for mortgages based on these low rates, and mortgage lenders and banks didn't approve them or qualify for them at the fully adjusted rate and the fully
Okay.
adjusted payment. Now, banks and lenders, underwriters, we have to qualify you at that max adjustable rate, at that max payment. So your ability to repay this ATR is what they call it, ability to repay rule, applies to adjustable rate mortgages, and banks and lenders have to approve you based on the max adjustable rate.
Okay. I also wanted to ask you, so those are two tools, right, that we have is the 2-1, and we're hopefully going to get sellers to pay that, potentially an adjustable rate mortgage. But is there anything else that you have in your pocket that you think like this would be a great option for somebody that's buying right now?
Yeah, well, two things to keep in mind. The first thing is if you are getting seller paid, you can buy down your fixed rate mortgage too. I mean, it doesn't have to be an adjustable rate. It doesn't have to be a 2-1 buy down. In any market, in any normal situation, you can always pay a little bit of money to get a lower rate. So if the rates are 7% and you want to pay a little money to make your fixed rate 6.5%, that option's always on the table. The other thing to keep in mind too, depending on your qualification, depending on the loan type and stuff, depending on what you're qualified for, you can use jumbo financing. So when we talk about jumbo mortgages, we're talking about mortgage loan amounts that are over like $647,000. That's the definition of a jumbo loan, over that conforming loan amount. But even if you're under that loan amount, even if you're at a $200,000, $300,000, $400,000 loan amount, you can still use jumbo mortgage products. So this is interesting, and this is something that kind of came about when mortgage rates started going up. Is if you are well qualified and you can qualify for a jumbo rate mortgage, you might get a little better rate if you can qualify for jumbo versus a conforming Fannie Freddie product. So that would be the other thing to keep in mind.
So why would qualifications, does that just mean like your income is better and your credit is better? Like because you would be able to qualify for these bigger loans, even though that's not actually the loan you're taking? Is that what you're
Right.
trying to say?
Yep. Even though you're not taking a quote unquote jumbo loan out, if you are someone who has better credit, lower debt ratios, if you've got savings or reserves in the bank above and beyond your month down payment, you can qualify for jumbo financing, which just have stricter rules, but you're typically getting a little better of a rate and maybe a little lower cost if you wanted to buy down that rate with a jumbo product.
And we've mentioned this buy down the rate thing a couple of times, and I did watch your video, which I'll actually put a link to that under my video in my description so you can see Chris's explanation of the 2-1 buy down. I think it was great. And he in there did like a spreadsheet that shows like this is how you figure out how much it's going to cost to buy down that rate and how much you would have to ask the sellers to contribute to like actually achieve that goal. So I love that. The other thing then is you're talking about buying down a rate like on a permanent basis. Is that the same format that they use to figure that out too? Or is there a different formula?
No, it's a little bit different, and that's based on the lender and your credit score. So in a normal situation, if you're just paying points to buy down your rate, not as a 2-1 buy down, but just to get a little lower rate, you can always pay points, or you can pay a fee to the bank or lender to get a little lower of a rate. Well, just as an example, let's just say that you're somewhat qualified, you're using a conventional loan, first-time home buyers or non-first-time home buyers who are under certain income limits can put as little as 3% down on a conventional purchase. And let's just say that your par rate is 7%, and you don't have to pay anything for that rate. The bank or the lender that you're working with just says, hey, that's your par rate, no cost rate, 7%. Well, if you say, hey, I'm willing to pay a little extra money to reduce my rate to get a better rate, you can pay a percentage point of your loan amount, for instance. So if your loan amount is $380,000, you would pay a point or $3,800 to reduce your rate a half point, as an example.
Okay. So it's 1%. So when you say a point, it's 1 percentage point of the loan amount.
Yep.
but it's not equivalent in one, it's not equivalent to like 1 percentage point off of your rate, but it would buy you down something.
Correct. So
But
you
that's
might
how
be
they
able to,
use that point language.
yeah, so it costs a point, which is kind of lender speak or bank speak for the fee that you pay. So you
Mm-hmm.
pay 1 point or 1% of your loan amount to get a little lower rate, and maybe it's like 6.5% instead of 7. So you can pay $3,800 to lower your rate half a percentage point from 7 to 6.5%. Maybe that saves you $100 a month. Okay. So the math, kind of the break even point on that is you pay $3,800, a $3,800 fee to lower your mortgage payment by $100. Well, 3,800 divided by 100 is 38 months or a little over 3 years of a break even point.
Mm-hmm.
So if you're going to be living in that house long term and you think, hey, I'm going to stay in this house, I'm not going to do anything with my mortgage for 3+ years. Well, it makes sense to pay a little money to buy down that rate and get a little lower rate and save, $100 a month.
Yeah, this is the kind of math that I love, or this is the kind of like example that I love, and like when this is a good idea, and the fact that you just put it, in that context of it's going to save me X dollars per month, and it's costing me X dollars to do it. Like if you're getting the seller to do it, well, who cares how long you stay, right? It's $3,800 in your pocket. But if you're doing
Yeah.
it, you care. So it's good for people to understand how they figure out what is this going to do? How does, how much is it going to cost me? What do they mean when they say points? So I appreciate that explanation.
Yeah, maybe I'll just say one thing about that too. It all depends on what is important to you. You might be looking at a situation where you can save $100 per month on your mortgage payment, and that makes a big difference, and that's kind of your objective. Or you might be saying, hey, I'd rather just, reduce my out-of-pocket expense to buy this house. Maybe I just want to save $3,800. I don't want to come up with this extra money at closing. I don't want to have that extra money out of pocket. I don't really care about saving $100 a month. That might be the situation too. So it's always a trade-off in the mortgage world: lower payment and higher out of pocket, or vice versa. So it all kind of depends on what's
Yeah,
important
keeping
to
that
you.
money liquid where you can use it if you need it or
Yeah.
earn interest on it, right? Like, thank you so much.
Cool.
I appreciate your time.
Yeah. Thanks,
I'll
Mary.
talk to you later. Bye bye.
All right.